Home Depot and Lowe's are two of the leading home improvement retailers in the world. As you can see, the operating earnings growth since coming out of the Great Recession for Lowe's has averaged over 17.68% per year, and that values it at a PE of 17.8. In contrast, Home Depot, the larger of the two, has grown at 15.23%, giving it a fair value of 15.23 times earnings. Both of these companies have clearly grown earnings very consistently, and even more importantly, perhaps, they've grown their dividend consistently, and both have reasonable payout ratios of the amount of earnings that they generate. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And today we're going to look at the two leading home improvement retailers, Home Depot and Lowe's. And what we're going to do here, I'm going to do something a little differently than I normally do. I'm going to talk about, how you identify great businesses. And later in this video, I'll have my son Colton go through the financial statements of these companies and try to, help ascertain which of the two companies has the stronger financial situation. In other words, which would be the best company financially. I'm going to look at it from the perspective of which is the best value. But there's something I want to talk about here a little bit. Just because we cover a company in a video doesn't mean that we're recommending that. It's one of my pet peeves with you guys. What I'm doing is I'm trying to give you lessons on valuations and lessons on investing. So I'm going to go through Home Depot and Lowe's here with you, and we're going to use the FastGraph Fundamental Analyzer research tool and try to show you how I would analyze the stocks, and I'll have Colton go through the financials for you and try to determine, which is the better company, but also determine when is a good time to invest in the company. It's not enough to know the best company. You also have to be able to buy the best company at the right valuation or an attractive valuation, because valuation matters, and it matters a lot. So let's go ahead and go into the fast graphs here. And let's start out with Lowe's. It's BBB plus rated, currently offers almost a 2% dividend yield, 1.97%. That's a little better than you could get in the market. Earnings yield of 6.07%, which indicates that the stock is probably fully valued, because I'd like to see a 6.5% or 7% or better. The valuation reference line that we've drawn here using this time frame, which goes back to the beginning of 2012. And I want you to notice the company has a January fiscal year. Its growth has averaged 17.68%, including estimates. Now, I do want you to notice that there's a down year expected this year. The company steadily grew earnings, and you can see the growth rates of earnings on a fast graph. They had a weak year in 2013 where they only grew by 4%. Then they followed that with 23% growth, 25% growth, 22% growth, 21% growth. And then coming out of COVID, which was very interesting, when a lot of companies were suffering, a lot of retailers especially, they ended up with 51% growth from fiscal 2020 to 2021, followed by another spectacular year of 35% growth, and then 15% growth. So now we're going to put weekly closing stock prices on the graph, and you're going to see that the stock was really attractively valued at the beginning with a PE of 17.1, just slightly below the fair value reference of 17.68. It's currently trading at a 16.47 PE. So when we look at performance over this time frame, this was an optimum time to buy Lowe's, in my opinion, because the price was at fair value and it was optimum. Now, it would have been better to buy it maybe 6 months later or so, in August of 2011. It would have been less optimum to buy it in 2015. But keep in mind, because this company grew so consistently, you would have still made money even if you bought it at this high valuation. Buying at a high valuation does not mean that you're going to necessarily lose money. It simply means that you had a company growing at 17% or better over this time frame, and you only earned 15%. So you earned less than you should have. That's all that means. But it also means you were taking more risk. Now, as you look into these later years here, 2020, 21, and so on, we had some pretty high valuations. In fact, if you'd have bought it at a peak valuation in 2022, Lowe's that is, and held it till today, you'd have held it from January of 2022 to June of 2023, and you would have been looking at a negative 5.98% rate of return. But yet this was during a time when the company really had some pretty good growth, and also during a time when they raised their dividend. So the point is It was just not a good time to be buying the stock. And that's what valuation is all about. It's not enough to know when the great company, this is clearly one of the leading companies on the planet, especially in the home improvement retail group. It's $131 billion in market cap. It's triple B plus rated. But by the way, the company does have 150% debt to capital. And I think that's something Colt's going to address a lot when he gets into the financial statements for you. But the point is, on this basis, using that growth rate, Lowe's looks slightly undervalued here. However, if I go, I'm learning from the past and I'm seeing what this growth rate has been. But now the real question is, what are analysts expecting going forward? So here I go to the forecasting graph. And we're expected muted growth for this year, maybe down 2 or 3%, followed by about 9.5 or 10% growth in 2025, then followed by 13% growth going forward. Now, the long-term average growth rate is expected to be 17%, which would still indicate that Lowe's would be very, very undervalued over the long run. I want to emphasize that. But if you're looking at the company from a standpoint of current, you could argue that it would be fully valued or just a tad overvalued and could have negative returns if these numbers came to pass and the stock traded at a more reasonable 15 times earnings for that growth. Then you could see the stock, at 14%. But if you look at the normal multiple, which has been about 19 or 20, then Lowe's could still make you a very attractive 31% annualized throughout this fiscal year, which ends January 31st, 2024, and going all the way out to the fiscal year ending 2026, it can still generate a 16% rate of return. But that's assuming a very high valuation. At the lower, estimation of around a 15 multiple, it would only be yielding you 6.27. The point is here, nobody knows what's going to happen. But what this is doing is these are what-if scenarios. What if the analysts were correct, and what if the company traded at these valuations? But you can also do other what-ifs. What if it traded at 18 times earnings, and my rate of return would be 13%? That's one of the beauties of the fast graph tool. What if it only traded at 10 times earnings? And then at that point, I would be, or 12 times earnings, I'd be losing maybe almost 6.5% a year on my money or so. So the point is, this is just cool to think with, and this is allowing you to calculate rate of return potentials based on what the analysts expect. Now, the long-term growth is expected to be high. One of the advantages of the custom calculator is you can go in there and you can include the near-term estimates with the long-term estimates, and that drops the rate of growth to about 12.57, but at even only a 15 multiple, which is what this is assuming this orange line is drawn at here, it would still be a double-digit return. So Lowe's looks pretty attractive from that basis. Now, going back to the historical data, the dividend growth has been extraordinary. So when we look at performance, I'm going to expect slightly less than 17.68% growth on this stock, and I'll clarify that here in a moment. So if I go to performance, I see that the growth component has actually been 19.45%, so I was wrong. But the company grew very well, add in dividends, and it averaged 20% annually versus only 11% for the S&P, and it paid almost twice as much in dividends. So, the performance during this time, which, by the way, this is an extraordinarily strong performance. Typically for the S&P, Lowe's did even better than that over the since coming out of the Great Recession. Now, I do want to make a couple other points before I leave this, and I'll make the same with Home Depot. These high valuations are happening at a time when interest rates, were pretty low. But as you know, the Fed's been raising interest rates, and that has a lot probably to do with resetting the business here. Now, existing home sales are actually slowing down quite a bit. New home sales are still relatively strong, according to an article I read in the Wall Street Journal. But the point is, home improvement is still considered to be very strong. And Lowe's, if you go into the external links here, you can go to a site like Seeking Alpha, for example, and you can read about the fact that, Lowe's gave some pretty positive commentary on what they thought would happen in the future. And then they also raised their dividend by 5%. So, the safest dividend is the one that's just been raised, as people often say. So Lowe's looks very attractive here, but the historical growth is not expected to match the future growth for the next couple of years, but longer term, it is. It is expected to match that, at 12 to 15% or higher. So Lowe's, might be attractive. It's not the best buy you can possibly buy right now, but I would argue that Lowe's is probably a good buy right now. Not a screaming bargain, but a good buy. Now let's go to the giant in the retail site, Home Depot, which has a $315 billion market cap. It's A-rated. Its debt to capital is also very high at 94%, but it's not the 150+% that we saw with Lowe's. Now, as we look at this, the market has been valuing this stock at a premium all the way since 2021. We've seen that it's been putting a 20 multiple, and this was a time during low interest rates, and once again, very strong performance. Home Depot actually performed for these first years up to COVID probably slightly better than Lowe's. It didn't have a 4%, if you remember, and it has a January fiscal year, but it grew at 22%, 26, 21, 22, 18, 19, 16, 33, and then coming into COVID, it had a relatively flat year, 4% growth. But then coming out of COVID, it didn't do what Lowe's did, but it grew at 16% and 30%. But remember, it's probably more than twice as big. But long run, this company has grown at over 15%, is expected to show some weakness, and that has brought the stock price down. But remember, these high valuations were during periods of low interest rates, and interest rates are, higher now, and they're expected to probably raise another time or two before it's all said and done. But again, that's speculation. Nobody knows that. Looking at Home Depot from a standpoint of operating cash flow, it looks fully valued, if not slightly overvalued. Looking at it from a standpoint of EBITDA, it looks maybe just fully valued, reasonably valued. It's had a normal price to EBITDA of around 11, and it's been pretty consistently trading at that. And I want to make a point here. These are how the market has been valuing this, and this has been in effect during a time of very low interest rates, and now we're getting into higher interest rates, and we've seen, these valuations kind of screaming, getting real high. So once interest rates started to rise, it wasn't, shouldn't have been a surprise that the valuations would reset a little bit. Now, looking at both these companies from a price to sales point of view, Home Depot looks a little overpriced. Going to Lowe's looks even more overpriced on a price to sales basis. But both of these companies are, good, strong growers and certainly have great strength in their respective business. But now, one of the subscribers to my channel, and I don't have his name right now, but I want to give him credit, kind of gave me an interesting idea to do. He asked me to do Lowe's and Home Depot. And he said, let's do a couple videos on twins from a different mother. And that's what you're really looking at here. What I want to make a point of, when you look at Home Depot and Lowe's, you see very, very similar characteristics, no matter what metric you look at, especially with operating earnings. Now, they're not identical, but they're pretty darn close. And both of these stocks, look very, very attractive from a standpoint of growth of earnings, growth of dividends, etc. Now, past performance, Home Depot, has maybe a little better number than Lowe's did during this time frame. But I want to remind you that Home Depot is also more overvalued than Lowe's was, even though it grew at a slightly lower rate. And it started out at a pretty attractive valuation, in the beginning as well. So valuation matters, and it matters a lot. What I'm really trying to get across here is when you're looking at these stocks, and you're analyzing them, you want to look at how's the market been normally valuing these businesses. They've been valuing Home Depot at a premium valuation, probably because it is such a high quality company. But there are issues. They do have a lot of debt. And we're going to talk about how, Colt's going to talk a little bit about, why they have so much debt and what they've done to their equity. And I'm going to leave that to him. So I'm going to let Colton now go over the financial statements for you.
Hey everyone, Colton Carnevale here. So once again, we're going to be looking at the financial statements for Lowe's and Home Depot, and specifically the balance sheet and cash flow statement on a quarterly basis. In comparing these two companies in terms of what I think looks better in terms of what financial statements look better and in which company seems to be a better set up company. So the first thing that I want to point out, I'm going to jump all the way down here to the common equity point and even kind of take a look at retained earnings. And I'll get into this on an Excel spreadsheet, but both of these companies have actually been doing massive share buybacks. And we're going to be seeing and investigating some common equity value, potential value issues, and then that this company actually has negative common equity. And Home Depot, in contrast, is just at about par with assets and liabilities, so just about zero common equity. And that is primarily due to them buying back a ton of shares. So they're increasing debt levels to buy back a ton of shares. and then using all of that cash and mostly spending it on share buybacks instead of keeping it as assets or, increasing the company from an asset perspective or reinvesting it into the company itself. They are more so in a way, giving it back to the shareholders, which, as Chuck has said many times, that doesn't always necessarily, share buybacks don't always necessarily mean a positive value for shareholders. But with that being said, let's take a look at an Excel spreadsheet. Once again, all of this data is findable from the FastGraphs app itself. I just brought it in here to run some calculations and compare some things. So there's a few items that I want to spend just a little bit of time looking at. We're going to be looking at cash values. So this is cash on the balance sheet. So both of these companies have kind of increased cash, ballooned it for a little bit, and then have somewhat decreased cash. We can see that on the Lowe's balance sheet and on the Home Depot balance sheet. Now, Lowe's since Q2 has gone from $876 million to $3.3 billion. But, we saw this large increase in cash right here. Same thing in a way with Home Depot. We saw a okay amount and then a large increase, and then ultimately it dropped way down. Once again, they're spending most of their cash on share buybacks during this time. And then, we've got inventories that we're going to look at, net property, plant and equipment, and then total assets. And mostly we're going to look at it as a percent of total assets. So cash and short-term investments on Lowe's represents a relative low percent. We saw this balloon, like we said. Home Depot, once again, they are both kind of par in terms of cash representing a low percent of their total assets. Now, inventories, if we take a look at that, inventories for Lowe's seems to represent a little bit higher of their balance sheet, of their total assets than what Home Depot has. Home Depot has ranged from 28% at the beginning here down to 21% now, sitting around 33%. So Lowe's is sitting around 40, low 40%, up from high 20s to low 30s. So Lowe's is less liquid in that sense of Home Depot. Home Depot has less of their assets tied up in inventories, which, technically could be less selling power, but once again, it is a little bit of a risk as well to have a lot tied up in inventories, because if you don't sell that inventory, then in order to get cash out of that inventory, you may need to sell it at a discount and whatnot. And then we're going to be taking a look in a little bit at some operating cash flow growths and as well as revenue growths for both of these companies. But now let's take a look back at Lowe's and take a look at long-term debt, and primarily as a percent of total liabilities. So once again, these companies have been going through massive share buybacks. And in order to do this, they have been taking out massive amounts of debt. And, Lowe's has gone from $20 billion in long-term debt to $39 billion. So that was representing 53% of their total liabilities all the way up to 65%. If we take a look at Home Depot, relatively the same picture for both companies. We are seeing 62%, and it's staying around 62%, but a high amount of their total liabilities being represented as long-term debt. And then one of the final things that I want to look at, and this is the total assets to total liabilities, which Lowe's has a negative equity value. They have more liabilities than assets, which is definitely not a good thing. Home Depot is a little bit better. Lowe's is sitting at a 0.76. So that means they have 75 cents of assets for every single dollar of liabilities that they have. Home Depot isn't much better, but it is better. At least it's around par value, right? They're keeping their assets pretty much equal to their liabilities. And once again, this is happening to both of these companies because of the massive share buybacks that they are going through. But in terms of a balance sheet perspective, I think Home Depot is set up significantly better than Lowe's. Also, something to take a look at, the total change of their total assets from Q1 2020 to Q2 of 2023. Home Depot has increased their total assets by 49%, while Lowe's has only increased it by 12%. Lowe's has increased their total liabilities by 55%, while Home Depot has only increased it by 40%. So Home Depot's increasing their total assets way more and increasing their liabilities less than Lowe's. So from a balance sheet perspective, I think Home Depot takes the cake. I think Home Depot is a better setup company from a balance sheet perspective. Now, taking a look at the cash flow statement, I've added in the last 12 months for operating cash flow, investing and financing cash flow, as well as looking at the net change in cash. And then something that's not found on the cash flow statement, but I added it in here anyways, is the last 12 months revenue and the total change for that as well. Something that is concerning to see for both of these companies, if we look at the last 12-month values, we are seeing massive drops in operating cash flow. So Lowe's having a minus 34% total change in operating cash flow. I mean, we went from 11.6 billion operating cash flow back in 2020 to 7.7 billion as of right now. If we take a look at Home Depot, they've dropped a lot less, but they're dropping as well. We've gone from 20 billion in operating cash flow to 16 billion. That's not a good sign. I don't like to see that in either one of these companies. And I believe these companies are going through quite a bit of manipulation to make their per share numbers look better, because once again, we're seeing this drop right here in operating cash flow. But we'll get into some comparisons of those numbers here in a minute in fun graphs. The last thing that I want to take a look at is the sales revenue and the total change in sales revenue. So Lowe's is increasing their sales revenue over this time by 12%, while Home Depot has increased it by 24%. So just kind of looking at these numbers and summing these ones up, I think one, Home Depot has a better balance sheet than Lowe's. Two, I think Home Depot has a better cash flow statement than Lowe's. Neither of them are that great. Their operating cash flow is shrinking, but Home Depot's operating cash flow is shrinking less than Lowe's. And then finally, when it comes to revenue, Home Depot is increasing their revenue faster than Lowe's. So all around, I think Home Depot is a better set up company. Now, one thing that I do want to just point out, and we're just going to look at it for Lowe's, is the manipulation or possible manipulation that these companies are going through. So let's take a look at sales revenue, and let's just take a look at the last 5 years of sales revenue. So from a per share perspective, Lowe's, for example, has increased sales revenue per share by 13.49%. But if we take a look at in millions number, so this is not shares, this is just flat out how much they made in pure amount of dollars, they've only increased their revenue by 7.18%. So these companies we're seeing their per share values increase significantly, mostly due to share buybacks, not the company operating in a better manner. Their revenue is growing, for example, but it is being compounded by the amount of share buybacks that are occurring. And that's causing their balance sheets to go out of whack. And then at the end of the day, cash is king, and we are seeing operating cash flow shrinking by both of these companies. So that's something to keep in mind when investing in these. But in one last little summary, if you're going to be comparing the two of these companies, just apple to apples, I think Home Depot overall is a better setup company than Lowe's. Thanks, Chuck.
All right, thank you, Colt. That was excellent. And again, I want to remind the viewer that we're not talking about, whether or not these are good investments today or not. In other words, that we're not saying you should buy or not buy these stocks today. What we're trying to do is give you a good idea of what these companies look like and how they've been valued. Both Home Depot and Lowe's, if you look at both of them from a standpoint of analyst estimates, have really excellent records of analysts getting the estimates correct. Lowe's missed one time on the one-year forecast during COVID, but they didn't really miss that badly. And in contrast, Home Depot really came in on the money in 2020. So the point I'm getting at is analysts, they give the companies good guidance, so their estimates have been really pretty on the money when you're looking at these companies. So there's a lot of credence to expect that these estimates might be reasonably accurate. I also want you to notice that analyst estimates, for 2023 were actually increasing since 6 months ago. Then for 2024, they started decreasing rather significantly. And then they also were decreasing significantly for 2025 and significantly for 2026. So there is a lull expected as the Fed is going through the process of raising interest rates. But, when we look at Lowe's and look at that same thing, we see estimates increased a little for 2023, but they've fallen for 2024, 2025, and 2026. These are all just facts that you should consider. Anyway, both of these are excellent companies. I think both of these companies can be bought and held for the long run, but I personally think the better valuation right now is Lowe's. But then you also have to take into consideration what Colton talked about on the financials. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs Fundamentals Analyzer software tool, aka Mr. Valuation. I want to thank you for watching this video. The idea here was we're looking at twins from a different mother. I really liked that. I think that was cute. What they look like as far as, where they sit in the investment structure today. They're both great companies. I think that goes without saying. The question is, are they great investments? Are they great buys today or not? We'll let you decide that for yourselves. Thanks for watching. If you like this video, give me a like, ring the bell, subscribe to the channel, and take a look at FastGraphs. What a great tool to help you really think your way through the process. You can analyze whether you're buying a stock at a price that makes sense or not. It shows you, you can also mark where you buy them and keep track of your ideas in the future. Just such a marvelous tool. I couldn't imagine investing in stocks without it. Thanks for watching.